How's everybody doing? Yeah? I was gonna come a little closer. Is that okay? Kind of a smaller room. Actually, Mark told me I could come closer because he said he wanted to answer a lot of questions during the presentation. He really likes, participating. Is that what we had talked about? Well, hey, thanks for having me. It's awesome to be here. I'm from West Michigan. Anybody been to Holland before? Yeah, not too far. I drove up last night. I didn't feel like waking up at like 4 a.m., but I'm really glad to be here. So, like Jennifer said, I mean, we're involved on the investment research side, portfolio management, trading, a lot of the things that I'm sure you're waking up at 8 a.m. presentation to hear a lot about. But we're going to talk about the market. So I hope everybody's excited. I will take some questions at the end as well. And if you want to speak individually, would love to do that too. So we're super high touch and happy to answer anything that comes to mind. Again, I'm Steve. I got raised in the business. A little background on me. I got raised in the business with my father, actually. He's been in the industry since 1979. So it's been a while, and always loved the industry, wanted to be a part of it, and got some industry credentials pretty early. I'm very thankful for that. And Steve Senior is still a mentor of mine today. So it's really awesome. I'm going to kind of go through a few components here. I mean, first I wanted to just start with the kind of big picture macroeconomic environment. And then I want to talk a little bit about the stock markets, and then a little bit about the bond markets. So that's kind of the structure of the presentation here. Anybody kind of, I don't know, there's been a lot of events here recently in the economy. Anybody heard of, turmoil with tariffs, or, AI bubbles, or markets at all-time highs, or, the Federal Reserve, shifting interest rates and monetary policy all over the place? There's been a lot going on, right? Are these things that are on people's minds a little bit? Yeah. I'll try and cover a few. It's funny, like over the years as we've done these, sometimes it's just like super boring. Like there's not a lot going on. There's not a lot to talk about. But right now there's like too much to talk about. So I'm gonna try and cover as much as we can. All right. I want to first start. There's been this term called a K-shaped economic recovery going on. I just wanted to highlight this briefly and kind of what this means. It's a little hard to see. And by the way, too, we are sending a video on all this too. So if you want to, pop some popcorn and check this out later and just kind of hang out, I'd be totally thrilled by that. But we are going to have that available. So just and we have the full slide deck too. If anybody wants all the slides, happy to share that. But this idea of a K-shaped recovery, it's this idea that like at one point, a lot of industries were kind of tracking each other. Is through COVID, and then through the recovery, or through kind of the drop in COVID, through prior to COVID. But since the recovery, there's been certain key parts of the economy that have been recovering at really a much greater pace than other parts of the economy. So this has been kind of from an economic standpoint, just I don't necessarily know if it's a concern, but it's just a change of dynamic. It kind of creating opportunities in certain aspects of the economy, being cautious in other parts of the economy. The other piece of this K-shaped recovery terminology or concept relates to the consumer. And the consumer is what, again, kind of K-shaped concept is. There's certain consumers that are spending more and more than other consumers. Specifically, the kind of concern maybe has been the wealthier consumers are driving a lot more of consumption, consumer spending of GDP, and consumer spending is the major component of GDP relative to lower income consumers. Lower income consumers have roughly tracked the acceleration in inflation based on their spending. So again, it's just not necessarily a major negative at the current state, but it's a dynamic we have to be aware of as we're looking at opportunity from an investment standpoint. One thing I found interesting as we were studying and kind of building some of the data around this is looking at the net worth of consumers, how that's changed over time. What we kind of found from 2005. So on the left part of the screen here, that's a picture at 2005. what we've found is 64% of this kind of net worth, global net worth, was represented by the top 10%, the wealthiest 10%, 64%. And if you fast forward back to now 2025, it's increased to 67.5%. So there's been a kind of an increase in the concentration of wealth in our country among the wealthiest 10% of the population. Um, what was kind of fascinating about this, though, what happened, and I don't have a slide on this, but what happened was between 2005 and 2015, that wealth actually it peaked. It actually peaked above 67.5%. I think it was like over 70%. And then from 2015 to 2025, the net worth, that concentration in net worth actually tiered back down a little bit to 67.5%. So I don't know if I think that part of the reason why I wanted to show this is I think that the media does a great job of like blowing this stuff up and making it sound like we're just headed for disaster and like everything that we do. And I think having some data behind this kind of thing is pretty eye-opening. Yes, there's been an increase in the concentration of wealth, but to me, it isn't crazy concerning because it had peaked and it's actually been coming back down. So I think that's actually a very good thing. The next thing, so that's some just economic kind of stuff. I like to talk a little bit about what the media is, throwing out there. Some of these terms and everything. There's such a poor job of like objective information, I feel like, on a lot of these things. And so like we really like to look at the data and put some more thought behind it. We're not trying to get viewership with this stuff. But monetary policy, that's been another huge topic on the macroeconomic front. I got really sick of it for the last like 3 years, 5 years. I got really sick of talking about inflation. I mean, everybody was talking about inflation, and I know it was rightfully so. There was a lot going on with inflation. I mean, I'm just like, I got sick of talking. Everybody was talking about inflation, especially as it pertained to the Federal Reserve and what monetary policy is going to be doing. It was all centered around inflation. And I don't know if you've noticed a bit, but a lot of the vernacular now on monetary policy is kind of shifting and evolving into employment. There's been more focus on jobs. There's been more focus on unemployment rate, that kind of a thing. And there's been a couple of reasons for that. I mean, but first of all, the Federal Reserve's dual mandate is price stability, inflation, and maximum employment. So looking at the jobs and that kind of stuff. So that's really the Federal Reserve's pretty simple mandate, is those two things. And if you boil it down, and that's their primary objective. So there's times when they have to focus more on inflation or more on jobs, which relate to it. It all relates to the economy. But I think as inflation, obviously, as it spiked up like crazy, kind of scared everybody. I mean, we haven't seen inflation rates like we had, right, for a long time. Then they were like, hey, we've got to attack inflation. Now it's been more about jobs because inflation has come down a bit, not at their target of 2%, but we're getting closer to their target, or at least we're not at like 10% or whatever. So we're closer to their target. And now there's some concerns, maybe some cracks in the job market that warrants their attention. As we look at jobs data, I think, and this is part of, if you follow any of the Federal Reserve meetings, we've had a lot of disagreements in the Federal Reserve around monetary policy, more so than we've seen in a long time. And I think part of that, and this is a macroeconomic consideration that we have to look at from an investment management standpoint, is, I mean, monetary policy is so influential with stock prices, bond prices, everything. Loans, so many things. When we look at kind of what's driving the Federal Reserve's decision making, that's where we're diving now into the jobs market. And right now, what we see on the right hand side of this chart, the new jobs, you can see kind of a steady. Do you see that like steady decline in new jobs data over the last number of periods there in the chart? The new jobs are shrinking. So this has been part of the Federal Reserve's concern is, hey, we're not creating as many jobs as we once were, and the new jobs are going down. Not negative, but obviously down. However, from an unemployment rate standpoint, currently around 4.4%. If we look at the 20-year average, you can actually see we're below it. I mean, the average is 5.8%. Not that that's a perfect, benchmark for us, but the unemployment rate is below average. So this is part of the conflict here is, yes, clearly, if I go back here, new jobs are reducing, but on the flip side, our unemployment rate isn't terrible. And, inflation is kind of coming down in check. So yes, there can be some concerns on the employment front, but it's not like it's abysmal right now or anything like that. And so that's where I think we're seeing some of that conflict in the Federal Reserve around, do we continue to cut rates to kind of support the job market, but at the risk of inflation going higher, or do we kind of pause and keep things as is? There's a fair bit of uncertainty right now with what the Fed is going to do around this. So I think this is, again, a pretty major consideration. One last thing on the kind of big picture macroeconomic side of things, I was just like kind of taking a step back on the stock and bond market, and stocks and bonds, obviously the kind of the largest flagship assets for most investors. How have they really performed, right? Like how have stocks and bonds? We hear a lot about correlation and we use stocks and bonds because they don't move together, right? Like they diversify each other. That's a big, investment principle. But when you look back through time and look over periods of this is super simple, but sometimes I like simple in this world, but positive returns for bonds, positive returns for stocks. That is in the upper right-hand corner right there. Positive returns for bonds, positive returns for stocks in a particular calendar year. 70% of the time is that environment. Now, the other environments you can kind of read through too, positive returns for bonds, negative returns for stocks, et cetera, et cetera. I think that it's a good reminder to just look at statistically, stocks and bonds typically do perform positively in the same calendar year. And last year was no different. Last year we had a pretty good environment for bonds and a pretty good environment for stocks, which I kind of wanted to make mention of this because the bond markets have been very volatile over the last number of years as the Fed had been increasing interest rates. So again, I think that's just a good reminder. So looking forward, I know this doesn't mean a whole lot to you, but I'll just kind of break it down here. Moving forward, when we look at the macroeconomic environment, there's a number of factors that our investment team likes to assess. Just again, this is more from a big picture economic standpoint. What factors drive a positive environment for stocks versus a better environment for bonds? From a investment philosophical standpoint, we do not time markets. We're not trying to make these extreme radical shifts into stocks or bonds or other things. We need a foundation of diversification for most investors across stocks and bonds. We believe in both assets, but we do also believe that there's environments that are a little bit more supportive of equity markets versus the fixed income markets. So there's a number of factors here like inflation, consumer savings rates, capital investment, leverage, corporate profitability, treasury rates. There's a variety of things that go into this economic model for us. And what I wanted to highlight is, although we're not negative on stocks, we are not as positive on stocks as we were last year. And so just visually to kind of give a picture of this. In 2025, we had a higher allocation in stocks based on this macroeconomic environment. That had served us well. That was a positive contributor for our investment strategies. But we are now kind of in more of a neutral position for equity versus fixed income in the current environment. So I don't want that to be scary or a negative thing. I mean, it's just all of this stuff is based on a lot of assumptions, but we just want to take prudent steps to make sure we're remaining diversified, especially as markets have the equity markets have done pretty well. And that's just a statement. I mean, based on kind of the higher valuations of equities, we're de-risking slightly. All right, so everybody good? So I'm about 5% done. I've got about 4.5 hours left. So you're still good. All right. There's coffee. You're not gonna offend me. Maybe some Mountain Dew over. No. All right. It's all right. All right. That was a joke. I'm not gonna be here 4.5 hours. All right, pivot, equity markets. Let's talk a little bit more about the stock markets. That's kind of big picture stuff. Hope that's a little bit helpful. Like I said, I can't cover everything. I thought it was natural, at 8 a.m. to talk about Big Macs, because I know everybody's so hungry right now. Everybody heard of the Big Mac Index? It's been around for a while, couple, yeah. I haven't talked about this in a while. I actually think I had this slide in a presentation like 10 years ago, which is kind of funny. But I want to talk about it in the context of currencies. There's been a lot kind of happening in the international markets. I think global trade, obviously the tariff stuff, currency changes, the foreign equity markets. There's been a lot more happening, I feel, internationally more recently over the last year than there has been in subsequent periods. Prior to about a year ago, the U.S. equity markets and everything, they were killing it. The U.S. equity markets outperforming pretty much everything, especially big company U.S. stocks doing so well from a return standpoint. So I think there's this behavioral bias called the home country bias that I like behavioral finance a lot, actually. There's some really funny studies on behavioral finance, but it's being here in the U.S., when our market's doing really well, it's easy to close off everything else and just be like, hey, we're going to invest in U.S. company. Everything's doing great, and we're here. Why not, right? But over the last year, the environment has changed a little bit, and I want to talk about that because there's a lot happening. But to start, this Big Mac index, it's essentially just how much does a Big Mac cost in other countries based on differences in currency prices, and it's kind of humorous to you can go Google it later. There's some funny stuff about it, but currencies are currency valuations and everything. It's a big driver. There's a lot of different correlations that happen with when the U.S. dollar isn't doing well. Over the last year or so, the U.S. dollar has depreciated in value relative to a long season of the dollar strengthening. And that does have a impact or does have a correlation to foreign equity prices that we're going to talk about. But in transparency, one funny thing that I found on the Big Mac index was there are some caveats. There's some very different Big Macs. I didn't realize this. Very different Big Macs in different areas. Now, in Alaska, the Denali Big Mac is like a double Big Mac. It's like 18 pounds of beef. I don't know. It's like crazy. I thought the McLobster was hilarious in Canada. And then in Korea, they have the bulgogi barbecue like Big Mac. So I'm like, that is some weird stuff. So anyway, if you want to try that stuff, that's cool. I'm not going to try it, but y'all can try that stuff. Back on track. All right. So currency returns. The first foundational thing, like from an educational standpoint on currencies, that I'm finding a lot of people don't really have a super clear understanding on is this kind of simple formula. It's not rocket science, but I think it's important to realize this, to understand where, if you're investing in foreign securities, where your returns are coming from. And so how this works is like if you're investing in a foreign asset like a foreign stock, which is very common today, you can invest in foreign stocks through ETFs, through mutual funds, through ADRs. Like, it's very, very common. But the return experienced by a U.S. investor of that foreign asset, it actually is broken down into two different components. One component is the actual return of the asset in that foreign currency. So that's the raw performance of that stock or that asset. And then the other component of the return is the performance of that foreign currency that foreign asset is denominated in relative to the US dollar. So most investors, if you're investing in foreign stocks, like, what I'm trying to say is you're kind of investing in that foreign currency at the same time as investing in that foreign asset or that foreign stock. Now, I don't think that's a bad thing. I think that there can be a good thing from currency diversification. But in periods of time when, like last year, where foreign stocks outperformed U.S. stocks pretty radically, there was a big chunk of that return for foreign stocks in last year that was just related to foreign currencies performing very well relative to the US dollar. So sometimes it's easy as investors to see, hey, I invested in this foreign stock ETF or something, it's up 30% or whatever. You naturally just thinking, well, that thing did really, really well. Well, a portion of it was just related to currencies. And so again, not a bad thing, but I think it's important to realize. I'll read this real quick. Historically, the U.S. dollar returns have correlated with foreign equity market returns. Recently, the U.S. dollar weakened by approximately 10% as the world became a little bit more unstable. Tariffs, China, Russia, Iran, all this stuff going on, leading to the resurgence of foreign market returns. So there is a statistical correlation when foreign currencies are doing well, foreign stock markets actually are doing well at similar periods of time. So there's a strong correlation, and that is what we have experienced. So I think a lot of questions around this, like, as investors, do we look at that and say, okay, U.S. markets have really dominated the equity market world for a decade or more, a long time. U.S. stocks outperform foreign. Last year, now we saw a pivot in this trend, a transition that I think is a little bit noteworthy and can begs a question: is that the beginning of a new trend where now foreign markets are going to start outperforming U.S. markets? I don't totally know, obviously, but there are some things to I think give us a little bit of context. One of those lenses, I guess, to clarify that we like to look at is this term price to earnings ratio, this research factor. I mean, it's essentially just what price are you paying for a unit of earnings in a particular company. Obviously, again, not rocket science, but do you want to pay a high price for earnings, or do you want to pay a low price for earnings? Any business people here? It's not super complicated, right? I would rather pay a low price to get more earnings, right? And that's kind of what this looks at, but it's not as simple as that, right? I mean, there's reasons why you might pay a higher price for earnings or a lower price for earnings. There are particular risks associated with companies. There's particular just growth opportunities. What does the future growth of those potential earnings look like? So just transparently, there's more to it just than that. However, if we just look at price to earnings ratios of U.S. stocks, 27 on average, PE ratio, foreign developed countries, so this isn't like emerging markets, just developed country stocks, 18. Anybody surprised by that a little bit? That's a big difference, right? I mean, for the same unit of earnings, right? Same amount of earnings, you're paying 27 in U.S. stocks versus 18. So that's a big difference. How I like to frame this in history a little bit is, I mean, foreign companies are going to have more risks, just in general. There's more factors impacting it. So one thing that I like to look at here is what has been I'll explain this real briefly, but what has been the average price to earnings ratio discount of foreign stocks versus US stocks. Foreign stocks generally are going to trade at a lower price to earnings ratio than US stocks because there's additional risks and other factors. So historically, foreign equity markets have traded at a 20% price to earnings ratio discount. That's been the historical discount. Right now, we're at a 32% discount. Okay. So that 18 versus that 27, that's at about a 32% discount. Whereas, again, historically, over the last couple of decades, it's been a 20% discount. So what that tells me is, yes, foreign stocks are priced lower than their average discount. So that is somewhat attractive. The markets, investment managers, they've talked about this for a long time. Because this trend has persisted. You can kind of see in the chart there, it's persisted for a little while, but I don't know. Part of me believes the catalyst of some of the foreign trade stuff and other things have maybe started a trend where we could see some better performance out of foreign equity markets. So again, for a variety of reasons, we're not like going all in or anything. Again, we're very balanced with our investment changes, but we are taking a little bit larger of a foreign allocation in our equity portfolios, in most of our equity portfolios. So it's just been some interesting trends. All right, artificial intelligence. No one has heard of this before, right? No one. Is everyone in the room using AI right now? Is there anybody in the room who's not like using AI? No. All right. Anybody else? No? That's brave enough to say no AI. All right. It is crazy. Like, it's wild how AI is finding its way into like daily life, every business application. We can't even, it's hard. Like, as we look at vendors for our business and stuff, like almost every technology vendor, there is an AI component. It is just, it's everywhere. And I think, as much as I hate talking about like trendy fad kind of moves in the markets, this one is a little bit more widespread, and I think it makes sense to dig a little bit deeper around like where the opportunities are, where the risks are, and how we should be thinking about the influence of AI from an investment management standpoint. So I found this a little bit helpful to break down where AI is, like where some of these companies are kind of focusing in terms of like which aspects of AI they're a part of. So you can kind of break it down into applications, infrastructure, the AI modeling, the large language models, and then the semiconductors. This isn't perfect, but it's a good visual, I think, of how widespread this whole AI shift has become, where it's influencing. There's a lot of business opportunities for companies to get involved with different aspects of the AI craze or AI phase here that we're going through, and it is pretty big. But with that said, I hope you like my cheesy humor. I just try and keep it a little bit lighthearted, but I wanted to share some very funny AI gone bad examples here. So we got to be a little bit careful with how we use AI, because these were some photos that AI helped generate for some actual business purposes that didn't really seem to make sense. I thought the workout instruction one was a little bit scary. I guess as is that children's book one, and AI can't get hands right. I don't know if anybody's found that. Like, hands just don't. They're still working on that. So anyway, so we got to be a little bit cautious on some of the AI stuff. But it's in seriousness, it's a big space, and there's a lot of interesting things happening. Now, I've heard a lot of people talk about AI, like this AI bubble, kind of depicting what we're in right now as an AI bubble, compared to the tech bubble, and I know I know we have some people here that were part of the tech bubble, right? Any investors in here that distinctly remember the tech bubble? Come on. Yeah. I was getting into the business. I got into the business right in about the year 2000. And I don't know if you ever had like experiences in life where where you're getting into something right at like the worst time, and then you have this like association in your mind, right, based on how you entered that particular field or that experience. And that was my experience when I entered the investment world. I started working for my dad's company, and um, year 2000. And if anybody remembers that, I mean, that's when the first time, right, that the world was like going to end. Then it ended again in '08, and then the world ended again in COVID. It's like the world's constantly ending in the finance world, but really the year 2000 is when I was getting in, and it was like that was right when the tech bubble was bursting, and it was like everybody's scared. So I think there's been I'm very thankful for that experience personally, because I don't know, like if I got into the business like right in the middle of this tech bubble, it's like everybody's making money. I remember my dad telling me, he was like, he remembers these people being interviewed in that tech bubble around like their companies are like, making a gazillion percent a year, these IPOs and all this stuff. And they're getting interviewed and they're like, so what does your company do? And these like founders on there, they're like, I don't even know, but we're making a lot of money, and it's like, this is nuts. So that's probably like not the best environment. So I got in the business when everything was breaking. But again, I do appreciate that balance. We have to understand the risks and the returns of investments. But this is just again comparing the tech bubble. I think it's I want to put data on it. So Netscape IPO 1995. I don't know if that's the exact beginning of the tech bubble, but it sounded good. If you look at that period to the very peak of that this is the tech bubble specifically, 1995 to it was March 27, 2000 was that peak there. Large cap tech stocks made 760% cumulative return over that time period. The other markets you can see, even like large cap, growth and value, and small cap, didn't do quite as well, but still pretty darn good. I just wanted to show that. Okay, 760%. Keep that number in your mind. Mark, I'm going to quiz you on this. So the AI bubble, ChatGPT, released in November of 2022 to the current point in time, because we haven't hit a top of a bubble. Is it a bubble? I don't know. But large cap tech over this time, 115%. What was the prior number? 760. So I don't know how that hits you, but that tech bubble seems to be a little bit different in terms of cumulative return based on what we've experienced thus far in the AI expansion. I don't know if it's a bubble. I'm sure there's going to be volatility, but it's not we haven't experienced those same total returns that we did in the tech bubble. So again, this isn't meant to say, hey, there's no risk, we got to go all in on tech stocks or anything. It's just, I want some balance here, because I hear so many people talking about AI bubble, got to get out. We can't invest in it. We got to move. We got to, and I always get concerned when people are making these very absolute statements around, hey, we're in this same thing, we've got to get out. No, there's some pretty material differences, even from something as simple as what the total returns have looked like. Another piece here that we've been talking a lot about, because this is kind of related to the AI trend, is I term it market breadth, where we have experienced, and I'm sure many of you are aware of this, we have experienced concentration of returns in a small number of stocks. I think everybody, we've had all these different terms of these, like top 7 stocks, top 10 stocks, top 5 stocks, whatever. And that's true. there has been a concentration of returns in a small number of stocks. And a lot of that has been associated with this AI trend. But I want to give a little bit of perspective. We use this term mega cap, which is the top 100 stocks in the US. If you look at the mega cap returns over the last 1, 5, 10, and 25 years versus the broad market. So the dark blue there, those are the top 100 companies. Those are the mega cap stocks. And then the light blue color there is the broad market. So that's like the broad, like Jennifer said, with the Russell 3000, with State Bank being a part of that, which is awesome. The broad market is like that Russell 3000, large companies, mid companies, small companies, more representative of the total market. And what you can see is over the last 10 years, mega caps have outperformed the broad market by a pretty significant margin. However, over the last 25 years, mega caps have actually underperformed the broad market by a slight amount, or they've been in parity. So I want to remind people of this, because in the current environment, again, I've heard so many people talk about like these big companies are doing great. Like it's both sides. One side is AI bubble is going to blow up. We got to get out of this stuff. The other side is these big companies, these mega caps, keep outperforming everything. We just have to invest in those and not the rest of the actual market. I think both of those extremes are really dangerous. I think we need representation of these different types of companies, but I don't want to dismiss smaller companies in our portfolios. There's a ton of small companies in the US and globally where it does make sense over the long term to keep those considered. All right. Bond markets. This is my last section. If anybody needs any coffee or anything, you're fine. You're not going to offend me. I appreciate your attention. Mark answering questions. We're doing great. Bond markets. And bonds are often pretty boring, right? Yeah. Bonds are pretty boring at times. I think monetary policy with rates going way up, that woke a lot of people up with bonds. Certain types of bonds lost more value in that rate hike cycle than a lot of stock investors. I think that scared a lot of people, because it's like bonds are supposed to be our safe component of our portfolios. Bonds are supposed to be that boring, safe risk management piece. And I guess although that's true, we have to be really careful with what types of bonds we're building into our portfolios. So we take bond investing super seriously. We do work with a lot of retirees and people depending on their portfolios for regular income, and having 20, 25% declines in the bond segment of the portfolio is not really the most desirable thing for that safe component of your portfolio. The bond markets are very big. There's a lot of different types of bonds. I think the industry has done a pretty poor job of educating on the different types of bonds, and specifically the different types of risks of certain bonds. I think a lot of people are aware of like long-term bonds versus short-term bonds, but in like the government bond market, but there's foreign bonds, there's high income, like high yield bonds, there's floating rate, variable rate bonds that the interest rates adjust with the interest rate environment. There's a lot of different types of bonds. And again, in light of the volatility of the monetary policy or the uncertainty, I would say at this point, I think this is something we've got to take really seriously, especially for the investors looking for risk management. I just have a few slides here that I wanted to share. The first topic is duration risk. Duration is a measure of interest rate volatility. Interest rate volatility, what that simply means is traditionally, if interest rates go up in the environment, bond prices go down, and vice versa. In an environment where there is some uncertainty of monetary policy, then higher duration, higher interest rate risk bonds, we just have to go into it knowing that they're going to be a little bit more volatile. traditionally, longer maturity bonds have more interest rate risk. There can be return potential there too at times, absolutely. But again, we have to be cognizant of the risks. We believe right now the risk of extending duration too quickly, extending the maturity of bonds out too early in the cycle that we're in, can add risk, and prioritizing shorter term maturities, especially when short term bond rates and yields are attractive. That aspect of that yield curve, which we'll talk about, feels a little bit higher return relative to the risk we're assuming. On the investment front, I always think about it that way, like, what's our expected return and how much risk are we taking for that? That's how I like to evaluate things. Because in the investment world, there's all sorts of options around that. How much return are we getting versus how much risk are we assuming? And so one slide, I really like this in the current environment right now, is what's happened with this is a year by year picture showing the range and the volatility of the 10-year yield over the course of just that calendar year. So what this means is in 2022, the 10-year bond rate ranged from 1.6 to 4.25% all in that calendar year, and it landed at 3.88%. You can see over time here, over the last number of years, there's been a narrowing of the volatility of that range of 10-year interest rates. Does that make sense? So again, that range in 2022, 1.6 to 4.2, that's a lot wider than the range in 2025 of 3.97 to 4.79. Does that make sense? Why I think that's important is I like this term rate discovery. The markets don't really know how to price the 10-year based on all the uncertainty in monetary policy. It's been volatile. We've needed to get more confidence in where rates are going to fall. And this is what I'm saying. As bond investors, I don't want volatility in interest rates. I don't want volatility like 2022, because that means bond prices are going all over the place too. So we want more confidence. So I think we're getting there. We're getting more confidence in terms of monetary policy and interest rate volatility, which then supports the bond market. But we just still have to be a little cautious before we start buying 30-year bonds that are going to be very interest rate sensitive. This is also, I think, a pretty kind of a wild picture of what has happened with bond or the yield curve interest rates over really the recent past. And to take you through this really, really quickly, I know it's pretty hard to see, but in 2023, that middle line that starts high and goes down, it's the darkest colored line there, that black line. That was a period of, we had an inverted yield curve. It means short-term interest rates were substantially higher than longer-term interest rates. And then the yield curve pushed up. So that highest line there, that's really when the bond market broke a bit, because all these interest rates swung up and bond prices conversely kind of went down when those interest rates went up. And now that blue line is where we're at today, or at the end of the year, where we do have a slightly normal yield curve, which is lower interest rates on short-term bonds, higher interest rates on long-term bonds. Why I show this is, again, kind of connected to the prior slide of, we need some more stability. We need a normal yield curve, which we're getting there finally. Although the very front end of the yield curve you can see is a little bit inverted, which is funny. But we're getting there. We're getting more consistency with yields, with interest rates, which is good for the bond markets. But at this point, we are staying a little bit shorter term with our bond market allocations until we get a little bit more stability in these yield environments. I want to finish up here. Just a couple of quick comments on the credit markets. so government bonds, that's one thing. There's a lot of other types of bonds, like I said. Investment grade corporate bonds right now are on average a yield of about 5.9%. It's a 5.9% interest rate or yield on the bond on corporate high quality credit. I mean, that's 5.9 is a pretty decent rate of return. In historically, they've been at 3.9%. So to some degree, back to the equity market de-risking that I started with in the presentation, it doesn't seem terrible to pick up a yield of 5.9% in certain credit markets in the bond environment. That's a really attractive yield. To kind of expand that even further, there's a segment of credit called high yield bonds. They have lower credit ratings. I think this bond market gets a little bit of a bad name. It also has the name junk bonds, and it's like, I was like, whoever want to buy a junk bond, it's like, that sounds terrible, But it's like, but there's different types of low quality bonds. Some are higher quality, but still in the low quality segment. Some are really, really bad and really junk bonds that have very low credit. So there's a range of these junk bonds. So you got to be a little careful. However, what's fascinating is, like, on average, it's around an 8% yield, 8% interest rate on those bonds right now. So if we can get the credit quality right in that low quality space, there's some really, really attractive yields right now. And one trend that I put this in here because I think, again, from an educational standpoint, it's really interesting, is the average credit quality in that low quality, in that junk bond space, has risen steadily over time. So when you think about junk bonds 10, 20 years ago versus high yield junk bonds today, the average credit rating has gone up pretty sizably over that extended period of time, which again kind of speaks to, I don't like just throwing them all out just because we're saying, hey, they're low quality. Some are very good. Some are very good companies. And the funny thing is, like with junk bonds, I find some people, they're investing in the stocks of those same companies. And they're like, oh, I'm not going to touch junk debt, but you're investing in the equities of the same companies issuing that junk. And it's like, as an equity investor, you're lower on the capital stack than the bondholder. So you'd be better off investing in the junk bond. You're going to get a higher return of capital if there is a financial difficulty for the company. So just kind of side note. But anyway, it's good stuff. Quality has risen as well. So final recap, I appreciate everybody hanging out and kind of talking through this stuff. Like I said, the first piece, I just talked about the macro environment. Covered, some of the trends with the K-shaped economy, some of the monetary policy stuff that's going on, and also just big picture stock versus bond allocations. The stock market themes, talked a bit about the foreign equity markets with currencies and all that fun stuff, as well as some of the trends happening in AI and how that's impacting the broader markets. And then finally, on the bond market side, spoke to duration risk, interest rate risk, as well as some of the trends happening with credit and some of the opportunities that we believe exist inside the credit markets. So that is all I had prepared for this wonderful morning. But like I said, I very much appreciate y'all. Thank you so much.